Okay. How are we all doing? Just drop a 1 into the chat if you can hear me properly. Let me refresh this, make sure it's all working. All right, cool. So, how is everybody? As you may know, or for those who know me, I am Mark. I have been trading for 7 years. I'm from London, and well, as you can probably see on the title, it's mostly fundamentals, but I wasn't always like that. I was previously a technicals trader, and I learned similar to how everybody else learned, where you see it online, it looks interesting, and then you go out and try and research it, and then you're like, oh wow, this is actually kind of cool. But unfortunately for myself, I was I'm sure we've all seen it. But then it got towards COVID. So I started in 2018 at the end of my first year at uni. And then it got towards COVID, obviously 2020. And I thought, you know what? There has to be something else that I could learn during this period. Because obviously at that time I was trading for about 2 years. Then it got to there and I was like, mate, I want to try and learn something new. So I went off and tried to learn fundamentals. Unfortunately for myself, nobody was really teaching it. If anything, it was quite complicated, which to be fair, it still is. However, I had to go the super long route because since no one's teaching it, I had to go and learn what I'm sure for some of us who may know about fundamentals, you might have to go out and learn what GDP is, what inflation is, what is interest rates, what is central banks, everything to do with fundamentals. I had to go around the long road. But eventually it started working out. Around 6 months into my fundamental journey is when I started to understand it. So how I like to teach people now is a fast track on how we do it, on how I would like to be taught. And that's what I'm going to try and help you during our session. So as you know, today we do have quite a big meeting. We obviously have the Fed, and we will talk about the Fed and what that means and how do we interpret that during trades, because it's all good knowing theory and it's all good knowing, this is what it means in a textbook and this is what it could suggest, but it's about how do we forward test that onto a trade, basically. So that's what I'll try and teach you. But I just want to see in the chat, how many of us know about fundamentals or would like to learn about fundamentals? Because if we just scroll out on my charts over here, now I'll pull up some interesting docs with us a bit later on. How many of us know about fundamentals or knows how to trade it or have even looked at it? Because how I looked at it when I first looked into all of this is I was looking at it and thinking there has to be reasons why we see big sell-offs in, like, this is the DXY by the way, why we see big sell-offs in these, big sell-offs in here, big rallies here, big rallies here. There has to be a reason. So that's why I went out and tried to learn it. Obviously, like I said, I had to go the long route round. Cool, it is what it is. But now what I've noticed, which is actually kind of good now, is a lot more people are interested in fundamentals. Previously, I was actually taught that fundamentals was literally going onto Forex Factory, looking at if it's a red folder news, if it's a green, buy it, if it's a red, sell it. Obviously, it does not work like that, but that's how I was taught. And it was always pushed to say it wasn't important. But if you realize that all of the big guests that Riz has brought onto Words of Wisdom, all of them mention one thing in particular, and that is fundamentals. So it's good to see that now a lot of people are starting to be exposed to it. It is difficult, don't get me wrong, but I'll try and break it down as best as I can. I would like to learn, that's good. I'd love to learn, but I only know about liquidity, that's fine. All these liquidity concepts are relatively new. Before 2020, it was kind of like very not really out there, to be honest with you. So it's, again, every strategy works to their own degree. It's just how you apply it as a trader. So fundamentals is meant to give you that sort of percentage edge, shall we say. So how I viewed it was, yes, it's going to take a bit of time. Yes, it's difficult, but if I can increase my probability of winning by 5 to 10%, why would I not try and do it? Because at the end of the day, we all here want to try and increase our probability in terms of how likely are we going to win in trading. But today was a great day for me. Cool. Fundamentals still confuse me again. I don't expect people to. Let me turn down the music a little bit for you. That should be better. Apologies, I didn't realize it was that loud. But nevertheless, where was I? Sorry. Excited to learn fundamentals. It's difficult. Don't get me wrong. It's not easy. But trust me, if you stick at it, it's one of those things, right? Where think about it in terms of when you started trading or when you started doing technicals. It was difficult. We've all been there. It was difficult, confusing. You go through periods of, oh, this doesn't make any sense to me. And then you go through a period of it does make sense. And then suddenly you're back in the mind blank of it doesn't make sense. And then eventually it makes sense again. It's exactly the same with fundamentals, where you go through a period of learning, it doesn't make any sense. And then you try and forward test it. You might make a couple of good trades. Now it starts to make sense. And then it doesn't. And then it eventually does again. So we'll see. I'll go through a lot of stuff. And again, what I like to do is I always talk about forward testing. Forward testing is very, very important because it's all good back testing, because back testing gives you confidence that what you're doing in terms of strategy, and you understand the strategy pretty well. But we know markets are quite dynamic in their nature, where it's always changing. And what we have to do when we learn fundamentals is to identify when shifts happen based on data, based on events, based on like wars, for example, that can obviously move markets. And then we have to go with where the flow is going. And we can only know where the flow is going by understanding what's happening in the world in terms of news. And that is what I'm going to try and do. I don't even know how to use fundamentals. Again, trust me, a lot of people don't. It is not an easy subject. It takes so much time to know. I would agree with that. So let's start off with all the good stuff, and we'll look at some news in particular. And what I want to try and do is I want it to be like a session where you ask me questions about stuff. Please challenge what I'm saying, because it's all good listening there. I mean, cool, that makes sense. But if you don't understand it, please ask, because that's important. So let's start off just with the calendar, because I always like to use Forex Factor. I always have since I started, just because it's very simple and very clean. There's other ones out there like Trading Economics. That's all great, and it has a good amount of data in it. But I like some stuff that's quite simple. So I'm a fairly simple person. So in terms of today being Wednesday, later on we have the Fed meeting. Now, for those who may know about economics or anything similar to that, does a rate cut, so you can see that they're expected to lower interest rates by 25 basis points or 0.25% from 4.25 to 4.00%. For those in the chat, can you let me know, is this going to be good for the dollar or bad for the dollar, or is it expected to stay the same? Because when you're doing fundamentals and even technicals as well, it's all good knowing the theory behind something, but if you don't know the context of it, you're going to lose anyway. So whenever you do charts, whenever you do technicals, whenever you do fundamentals, you have to know what the context is. So what would you say, in your opinion, a move from 4.25 to 4%, is that going to be good or bad for the dollar? Good for the dollar, bad for the dollar? Interesting. Why would you say good for the dollar? And this is, I'm thinking in terms of context now, because for the playbook, right, in terms of what it says in the actual book, it suggests a rate cut should be technically bad for a currency, because when you trade, when you're looking at FX, right, all you're doing is you're following the flow of money. That's all you're simply doing. You're following where the money is going to flow. How do you identify where this money is going to flow? By looking at what's happening in the world. That's why, for example, you see when there's wars, you see money flow to oil. Let's say there's a war in the Middle East and you see, for example, supply chain issues. Some of the refiners get bombed, or you see bad weather in the southern parts of the US where there's a lot of refineries in Texas and those regions. That is supply chain issues, or some of the supplies are, or the supply or the way the oil is refined gets hurt. Money flows into oil because there's less supply of it. And as you probably know, if there's less supply of something and a decent amount of demand, prices go higher. In FX, all you're trying to identify is where is the money likely to flow based on what we know. That's when you get, if we go on the daily time frame, let's wait for my chart to load. Oh, stay on this page. This is why you get big shifts higher in the DXY, big shifts lower in the DXY. You get pullbacks. And by the way, these pullbacks happen for reasons. They don't just happen because they need to happen. They happen for reasons. The best example of that in terms of live markets, because I always like to look at what's happening as of right now, because it's more, a lot more people are looking at it. Look at gold. Gold is a perfect example of a pullback has to happen for a reason. That's what we focus on. So if we look at gold prices, I think it's come a lot lower than some of the demand zones I was looking at. But gold prices were rallying for quite a while through this period. Cool. It happened because of uncertainty. It happened because of the US. It was happening because of we had a bit of issues with China and the US in terms of the trade deals. Then suddenly we saw a huge pullback. And the reason, one of the main reasons why that happened is because the reason it was rallying so aggressively started to fade away. Meaning, if you are following during the time of when you're trading gold, right, and you saw it rally, all you're thinking about is as follows. Let me zoom in. Actually, let me go to a white bit of the chart. All you're doing is you're simply following this. Asking this, shall we say, why is gold rallying? Let's say it's uncertainty and it's China and the US trade deal. Cool. Then you start to think, always when you look at fundamentals, I'm trying to give you quite a good little snapshot of it all. When you're looking at fundamentals, always think opposite of the reason it's going higher. Meaning, if the reason gold was doing so well is because of uncertainty, China-US trade deals, obviously you can throw in the angle of rate cuts from the Fed, lower yields. That's all pretty good for the gold. That's cool. Then we start to see this half of the angle slowly fade away. Meaning, gold was going higher. Oh, spelling is off today. Higher because of this. Then this starts to get taken out. Let's say we delete it. Now there's less reasons for it to go higher. Then you think profit taking. Now, if we add on another angle of how do we know when gold is now going to go higher, is think the reason it's so weak is that's now starting to fade away. That is how we trade fundamentals, by the way. You just think, what could happen right now? What does this mean for the future? And then that's a trade idea. You hold that trade idea, you continue with that view until you see that view start to get attacked or it start fading away, and that's when you take profits and go opposite to the direction. Sorry, let me just quickly read through some of this. If I go off in tangents, for those who know me, I love to go off in tangents, so just please drop it in the chat and say, Mark, let's get back on track, please. But if FMC is good for DXY, then what NQ likely does? Cool. That's a good question. So we all know the theory of dollar goes lower equals equities goes higher. We all know that theory, right? But there's a reason why that happens. So because we have the Fed today, let's remove the equation of it's priced in, it's already expected. Obviously, the question I asked earlier about whether or not 4.25 to 4% move is going to be positive or negative or neutral for the dollar, it's probably going to be neutral because people have already anticipated it. But let's remove that out of the equation and let's just think in raw terms, dollar goes lower, equity goes higher. Cool. The reason that happens, if we look at it from the angle of the Fed, let's say Fed cuts. Remember the flow of money. So let me ask this question. If there's less interest rates in an economy, money removes itself out of that economy and goes into somewhere else that has better yield. Meaning, we'll talk about hawkish and dovish in our many, many YouTube sessions together. And hopefully it will make a lot more sense to you going forward. But dollar goes lower, equities go high because the flow of money comes out of the US because investors and traders, of course, sees that they can get better yield going elsewhere. Equities sees higher prices because what is an equity? Can anybody answer me this question? This one right here. And I understand there's a little bit of lag between when I say something and it's on YouTube. So if I pause for a while, I'm just trying to see if questions comes through. Do you think rate cuts are already priced in the DXY? Yes. Yeah. If it's already on these news websites, it's already been priced in. Markets already anticipate it. That's the best way of looking at it. You can look at other stuff to understand if markets are priced in by looking at forwards, by looking at bonds, by looking at swaps. Obviously, there's multiple ways of doing it, but if it's already on a chart or on like a calendar, it's already priced in. That's the best way of looking at it. I think DXY has retested bullish to decide whether to move in response to a rate cut. Yes. Obviously, we'll speak about that a bit more later on in terms of what we want to be focused on when we look at the Fed. Mark, it's an honor to be here. Good to have you. So if interest rates go up, gold should rally. Kind of the opposite. If interest rates go higher, gold goes lower because gold is a non-interest rate bearing currency or commodity, meaning it doesn't create yield. It just has its value. The reason that happens is because when interest rates go higher, you have something called real yields. And we'll speak about this way down the line. This is quite fairly complicated stuff. But real yields tends to go higher because, remember, if inflation goes higher, interest rates tends to rise. So if real yields go higher, that's basically nominal versus inflation, which means if you buy a bond, inflation's not eroding it away if it's positive. Obviously, like I said, we'll speak about this many, many, many times in the future because it's quite complicated, but that's generally the relationship between gold. If interest rates go high, gold goes lower. Interest rates goes lower, gold goes higher. In gold, right? Yeah. Gold usually has an inverse correlation with dollar. That's why I'm thinking of rate cuts. Yeah, it's pretty much what I mentioned here. Don't understand the terms. That's fine. We'll talk about it. But an equity, for those who don't know, is made up of companies. So think about it from your perspective, because it's always interesting to think from how you would view it. If you're a company and you are paying higher interest rates, are you more or less likely to borrow in the future? Are you more or less likely to hire in the future if you're paying out more for just interest on the loan? These questions are stuff you should be asking. So if rates are expected to go lower, equities, meaning companies, sees cheaper borrowing costs. Now it's easier to build the growth because it's cheaper, easier to hire because you don't need to spend so much, so you don't have to reevaluate what this means. And therefore, prices, expectations goes higher. Does that make sense? Easier to build growth, easier to hire. Price expectations goes higher because it's much cheaper. As a result, equities go higher. That's the general relationship between when interest rates are cut, what it means for the dollar and what it means for equities. That's the relationship between them. Context obviously is important, like I said, so that's why you do have to kind of think, is it priced in? What's going on in the world at the moment? What's the expectation of the Fed? Like I said, this is all relatively complicated stuff, so I'm not trying to overload you on the first session, but I just want to pique your interest to understand if we have this expectation of what could happen, then it becomes tradable. Meaning, if you expect in the future the BOE to cut more, by the way, that's one of the reasons why the pound is so weak at the moment. If you expect the BOE to cut more because lower CPI, we all know what CPI is, lower growth expectations, this suggests weakness from central bank, which then equals more rate cuts, which then equals lower currency. So remember, you're following the flow of money. Where is money going to go? Again, let's put ourselves in the shoes again. You are an investor or you are a trader at an institution and you want to grab as much yield as possible. Are you going to invest into a country or a currency if you have weak growth, political issues, weak inflation? Are you going to invest just on those three? Probably not, right? So therefore, you will stay short that currency for the time being until what we spoke about right at the start, where you think, what? If the currency is going lower, context. Why? How much more is this going to go? This is why you have the calendar. You go straight onto the calendar and each week you just go through the motion of seeing, is there any update? Is everything still telling us to remain bearish? If it is, you hold that trade. You continue to hold it until it doesn't make sense anymore. Or you see the reason it's weaker starting to change. And once you see that is when you exit the sell and you go slightly long it on a shorter term horizon. That's kind of how you do it. But again, this took me 5 years in terms of, I've done fundamentals for 5 years. I've been trading for 7. So this is all just knowledge I've picked up after many years. I'm in UNC status now, but many years of doing this. I have to go. No worries. Good to have you here. A raise in interest rate should correct. Remember, you're following the you're following the flow of money. So if interest rates go higher, it's from an investor perspective, they're getting more yield. Here is a much more relevant example. Does anybody know why you pay swaps out or collect swaps? What are swaps? That's the question. The easiest way to understand swaps. Does anybody know what that is? Any fundamental technical reason why GU is so weak? Fundamentals will drive technicals. So if you know that fundamentally it's weak because we had CPI I think last week. Growth in the UK is not great. We have political issues from the fiscal meeting next month. This is not an environment where the pound sees goodness. It's an environment where we see weakness. As a result, you stay bearish the currency until one of these three things here that I spoke about begin to change. If it's not changing, you remain bearish the currency. But that's pretty much. And then technicals will follow that idea. So that's why if you can have a good bias from a fundamentals, you can know in the future where technicals are going to go. Because technicals are past data. It tells you what's happened past in the previous, months and weeks before that. What we have to try and understand is how do we understand where it could go in the future based on what we know right now. And that's why fundamentals are so difficult, because it takes a long time to learn and it's not easy. But how I viewed it at, I'm not a smart person, but how I viewed it at was, if I could just increase the probability by 5-10%, I'll take that every day of the week. So that makes it good, right? I'm not sure what you were answering about that. But the question was... Wait, I had a mind blank now. Someone remind me what the question was. Technicals? No, someone might have to remind me about what the technicals, what that question was. Sorry, I went off in another tangent. But nonetheless, all we do is look through the calendar each week and think, is what we're seeing right now making sense for us to say short the dollar? Or, in other words, is what we right now, for those who like to trade equities, is what we right now make sense for us to continue to buy the S&P? Does it still make us swaps? Perfect. Yes. Now I remember. Swaps. Cool. Does anybody know what swaps are? How is it calculated? Because you might see, oh, damn it, I've paid negative $50 or £50 on this swap, or I've gained £20 on this swap. That happens because of one thing. Make sure you like Safran. If it's good or bad for the dollar. Yes, that's correct. Good. So swaps are calculated by the overnight interest rates, meaning, have you noticed where if you sell USD JPY, you pay out swaps? Because the way it works, right, is, let's say, I don't know, the overnight interest rates are in the US at 1.5%, for example. Well, the easiest way to understand is just look at the standard interest rates. So right now in the US, we're at 4.25%. Then what you do is you look at Japan. And if I remember correctly, let me quickly have a little look. Trading economics. I think it's 0.5% for Japan, if I remember correctly. Yeah, 0.5%. Cool. So those are the interest rates for these current countries right here. But because you're selling US, basically you're selling dollar yen. What you're basically doing is you're buying JPY versus the dollar, right? So what you're essentially doing here is you're borrowing from the US, you're putting it into Japan. What that basically means is now you're going to be paying out negative swaps because interest rates in Japan is much lower. Hence why when you sell dollar yen, you pay swaps out. When you buy dollar yen, you're selling the yen, you're buying into the US, so you get paid swaps. That's pretty much how it is, how it works. So, we'll get onto this. All of this stuff much later on. But let's come back to my little thing. How I view it all at, right, is it's all good knowing theory, right? It's all good knowing what the textbook says. But if you haven't got that... Where is all that text? I'm trying to remember now. I remember where all that text went. But it's all good knowing theory. How we apply that to technicals is another question. Here's how we do it. So, and we'll get into more educational sessions in sort of the next few weeks. But this is how we do it. Let me delete all of this. This is all old stuff. So you have your view. Let's say you want to buy dollar yen, or let's say buy euro dollar. So euro USD buys, because fundamentally it makes sense, right? So fundamentals says buy. How we apply that onto technicals is as follows. How I always like to do stuff is I don't go against what the trend is saying from a fundamental perspective. Meaning, if we think about the gold example, in the future, we know the Fed is expected to cut by more. The US data is expected to be pretty poor. We know yields are going to come lower. We know that the China... trying to think if there could be anything else in the future. I'm sure at some point, again, the US and China little trade deal is going to flare back up. Cool. Those are 3 examples of why gold should go higher. Even if technicals are going lower, meaning it's making lower lows and lower highs, I still have a bias to long. What that doesn't mean is I buy, take unnecessary losses. I have to use technicals to help us get in. So how I view it is technicals is an entry and risk management tool. Fundamentals tells us direction. So how I would view it is, let's say euro dollar is going lower like this. So we're making lower lows and lower highs. Cool. How do we get in? So because I'm buying, my strategy in terms of technicals is just supply and demand. Nothing more, nothing less. So I'm looking now only for demand zones. So what do? We come lower, we've made a lower high or high lows and higher highs. And we now start to pull back. What do we ask ourselves on the pullback? Why is this happening? That's the question we ask ourselves. Why is this pullback happening? Remember, pullbacks doesn't happen for just reasons. I'm talking about high time frame. 4 hour, daily, these big pullbacks that we see on the charts, they happen for reasons. So if we ask ourselves, why is this pullback happening? If you believe it's short term, then you know that the pullback is going to be shallow. If you see that it's a little bit of a larger issue, the pullback will be a slightly bigger pullback, but that doesn't change the overall bias. So what I then do is I only look for demand zones. Let's say there's a demand zone down there, or there's a demand zone here. How many times have we seen, let me ask this question, where let's say you buy at this demand zone right here. So let me zoom in. And zoom in again. Is it going to let me? There we go. How many times have we seen this? Where you buy up. Where is my tool? We buy here. You buy, cool. You get into a bit of profit. And then it comes all the way back down through your stop loss. And then you look for another demand zone. And then that demand zone is the reason it goes higher. So you take an unnecessary loss there. It makes no new lower lows and lower highs. You try and buy it at another demand zone. It gets hit again. And then it comes down to another region of demand. But then that seems to be the reason why that chart moves. And it goes higher again. How many of us have seen this before? Today I realized that technicals are too simple compared to fund. Don't even know how to... That's fine. Again, fundamentals is not easy. Technicals, again, technicals are good because you need to know roughly what the chart is doing, obviously. And you need to know roughly how much am I going to risk per trade or where can a target be. But that's as much as it gets to, isn't it? So what you have to think is what is the driving horse behind why those technicals are moving. But yeah, how many of us have seen where you hit a demand zone, it comes a little bit higher, you take an unnecessary loss and then you think, oh, damn it. And then it goes low and then it goes higher. The way I've eliminated that to a certain degree is as follows. I'll show you how I have eliminated. Again, I'm still a sucker to get sucked in, take a little bit of a long, it goes in profit and then it takes a loss. But I've tried to, the way I've done it is I've tried to eliminate as much possible, as much of these scenarios as possible, shall we say. So let's say we get down here, really get down here. The way I like to do it, because my bias is still long, remember, nothing changes on the downtrend. I don't sell the downtrend because the trend is still pointing upwards. I don't care if the 5-minute structure or the 15-minute structure is going lower. That doesn't bother me. What I think is, where is the structure going to be in the future? If I believe it's going to go higher, I only look for demand zones. So what I'll do is it comes into this demand zone down here. We come lower, and then we see a break of structure. People call it market structure shift. It's pretty much break of structure. Then you see the lower high get broken. Now the opportunity is there because you have alignment from fundamentals. You now have alignment from technicals. So now that's 2 out of 2 in what you want to see. And now that's the opportunity to get in. So what you then do is you wait for the pullback to happen on the lower time frame. So I'll do this on like the hourly. It then pulls back, let's say into a demand zone, because remember, I'm only looking to long, and then I long it. And what do I do through this whole long period? Just think opposite. Meaning, why is it going higher? That's it. That's the question you ask yourselves on the uptrend. Why is it going higher? Is it changing? That's it. That's all you have to do. If it starts to change, what do you then see? You then see a pullback. Ask yourself the opposite. Why is it going lower? Is it starting to change? Yes, that's when you start to see break of structures that you see on your chart. That's all we do. Seems simple enough, obviously, if the way I put it like this, but it's kind of like technicals, right? If you go to like a new person who's never done technicals before and you talk about all of your strategy, it will be very confusing to them. But once they start to learn it and get through the motion, it makes a lot more sense. So, giveaways. Who likes a good giveaway? I know I do. Who likes a good giveaway? If anyone learns economics, can it relate with trading? Yes. The traders you see, what time frame you most likely determine your supply and demand? I'll get onto that probably next week because I'll go through my whole technical strategy because obviously technicals doesn't take too long. It's actually pretty simple. What I'll do is, let me just give you a very brief overview, is I'll go on the weekly because let's say I'm long. I'll go on the weekly, try and find a demand zone, mark it out, then drop down to the daily, see if there's a demand zone. You can see my my time frames here. I'll start on the weekly. If there's a demand zone there, drop to the daily, drop to the 12, drop to the 8, drop to the 6, then drop to the 4. All I'm doing through those periods is finding where areas of demand is and then marking them out. And then as the charts get into that zone, then I'll wait for breaker structures, let's say on the hourly. So I'll wait for a lower high to be broken because I'm looking to long. Then I'll wait for the pullback and then I'll get in because I have fundamentally it makes sense. Technically it makes sense. Cool. So yeah, in terms of giveaways, let's have a little look. If you type the word !join, you should be able to be entered. And then I'll get sent a list and then I will go on the little spin wheel. And what we have to offer is as follows. So if I just type it up, I shall show you. We have as follows. Apex, one funded next account, and one trade Zella 3-month account for you. So if you just type !join, you'll get your name will appear and then I'll get sent the names and then I'll chuck it into one of those spin name things and then we'll see who wins. Cool. So let's get back onto the charts now. And lastly, before we say anything, do not try and type it twice so you get 2. It will remove you because obviously it's a little bit unfair. So just type it once. I know, don't get me wrong, I would love to type !join as many times so I can get an entry, but unfortunately we have to try and make it as fair for people as possible. Cool. Now that I've got that under the way, let's have a little look now at what institutions have to say. Who is interested in knowing what some banks think? Generally, that it's not really it's all good knowing what someone's saying, right? What you have to remember is you don't use that as a bias. Never use what institutions are saying as bias. Meaning, you don't just go and think, oh, Barclays are looking to buy Eurodollar. Now let me go out and buy it. What you have to do is have your own bias first and then look at what other people are saying. That's the most important one. So whenever you see somebody say, oh, let me try and buy Eurodollar because this bank is suggesting to do so, they will get it wrong as well. So you have to do your own bias. So we'll look at some institutions as well, what they have to say. We'll try and interpret it to as much degree as we could. And I'll try and explain and break down what they are saying to a certain degree. So before I do that, let me just quickly change my thing over. Dark mode. For some reason, I have my PC going into dark mode at specific hours, so it will look weird if I pull up certain docs. So let me just chuck it back to the light mode. Perfect. So let me quickly share my screen over here. And what I'm going to do is show you some thought processes from specific banks. Now, like I said, please don't use these guys' biases as your own fundamental bias. Meaning, let me just zoom out so it's a little bit easier. Meaning, let's say, I don't know, let's go all the way down and look at their forecasts. If they're looking for Eurodollar to go to 120 on a 3-month horizon, although I do agree with that, by the way, that doesn't mean you now need to go out and buy. It means you have to interpret it as they're looking to buy. Why are they looking to buy? And as a result, then we look at it. We'll start the giveaway soonish. We just got to let the list build and then we'll chuck it in onto that will name website. But you don't just look at what these guys are saying and then buying it. If you take a loss, that's kind of on you. So let's quickly have a little look then at what some people are saying about specific currencies. Let's start off with the pound. So this is their view on the pound, and a lot of it will not make sense. But what I'm trying to do is teach you through our sessions how to interpret what these institutions say and whether or not you agree with it based on your own perspective, your own viewpoints. So what they're looking for is slowing inflation, fading fiscal. We'll speak about fiscal in another session. Fiscal is just government. Slowing inflation. Based on what we spoke about right at the start, if inflation comes lower, what happens to interest rates? Can anybody ask me what that is? What do you think happens to interest rates when inflation comes lower? Does it go lower or does it go higher? Let's see. Nobody? Let me actually restart this. Cool. That should be a bit better. So, lower. Lower. Okay, interesting. I always like to try and, peek as to why that is the case. But you are all correct. Generally, what happens with interest rates on textbook, inflation comes lower, cut. Why is that? Well, think about the whole premise of what an interest rate is. If interest rates are higher, they suppress inflation because it's more expensive, isn't it? It's more expensive to borrow. Just think about it from your own perspective. What has happened since interest rates, I'm in the UK, it's obviously the same in the US as well. I'm in the UK and the BOE were relatively, I'm trying to remember now, if they were late or early to rates. I can't remember, so long ago, I can't remember that far back. But interest rates in higher. Why is that higher? So what they have to do is they have to keep interest rates high to bring inflation lower, because higher interest rates is more expensive for companies. It's more expensive for you because phone bills are more expensive. Mortgages are more expensive if you're on a variable rate mortgage. Car finance is more expensive. Just everything in general is expensive. That slows growth down. And as a result, if there's less buying, inflation comes lower. That's the whole premise. And as inflation comes lower, they no longer need to keep rates that high. And cut. Stabilize it. We know what the perfect Goldilocks zone is for inflation. So you might have heard about this term before. What is that specific inflation at? Meaning, is it 3%? Is it 2%? Is it 1%? Is it 0%? What is the Goldilocks zone according to the, remember, book? The reason I put it in quotations, is because it's all good. Knowing it in theory is how we apply that onto technicals or onto the charts. Apologies if I was cutting out. I believe that was my speaker trying to take over. A moving money, if the interest rate comes down, people call 2%, 3%, 2%. Okay. Interesting. 1%. I'm sure we'd all love that, 1%. 2% is actually the best scenario for it, but specifically for different economies, you do have like 3% for like Canada, for example. They anywhere between 1 and 3% is good for them. US is 2%, UK is 2%, but generally 2%. So we know in the US at the moment that interest rates is higher than 2%. We know in the UK that inflation, is higher than 2%. We know that inflation in the UK is higher than 2%. So what do they have to do? They have to keep rates high to bring inflation lower. And as it comes lower, they have to cut because they don't want to keep it higher, because that will just bring inflation way below 2%. So they're going to have to it's like a balancing scale, and it's not easy to do. As inflation goes up, more people are taking out money from the market, and once money takes out the market interest rates, it's just like a never-ending circle. It's like a cycle of people make money, they then go and spend more. As interest rates goes higher, people spend less, and then that brings inflation, and then that can bring equities, and then it's just a whole cycle. But for a central bank, they have to what's the word I'm looking for? Balance. So let's just quickly have a look at what Goldman is saying. So they're actually looking for GU to remain less vulnerable vehicle, slowing UK data, lower front-end yields. We'll speak about that in many sessions ahead. Supported by gradual headwind from sterling's higher valuation. Then they're going to talk about second autumn's budget remains focused. So that's about what we spoke last year about next month. And while could be slight negative inflation, implying negative, we think elevated option premium will at least being partially priced in. So they're looking for the pound to underperform based on these scenarios. You can pause through this and read through this in your own time. But they get a whole fundamental reason why they want to do that. Then they go out and apply that onto technicals. That's all they do, by the way. They get a big reason, then they go out and apply it. Let's have a little look at some other stuff as well, by the way, because I don't want to just show you Goldman. I want to try and show you that, all of these big guys, we all say we want to follow what the banks are doing. We've all heard this term before, but we're not doing what they're doing, if that makes sense. All of these big guys, or the people at the banks, we're not talking about algos here, we're talking about actual traders at desks. They're trying to formulate trade ideas for clients based on what is happening in the world at the moment. And from there, they either make money or they obviously lose money. If they're doing all of this, why are we not doing that as well? That's the question that I asked myself when I went off and tried to learn fundamentals is, these guys are doing it. We all see about the news. We all see Bloomberg. We all see Reuters, news websites. And they all talk about it, but why are we not doing it? And I think there's a really big concept for that. And this is just my opinion. The reason why this is not so mainstream is because of how difficult it is. And in trading, a lot of people online, they try and make out that trading is super easy. You go onto the chart, you draw a couple of lines, and now you make money. It does not really work like that. So I think that's one of the big reasons why it's not really pushed. It's because it's so difficult to learn. But there's a reason why it's not difficult to learn, because no one's tried to learn it so they can simplify it. And that's what I'm trying to help you with. Let's look at some other people as well. Let's look at JP Morgan. So this is their sales and trading view, or that's from their sales and trading team at the London branch, which is in Canary Wharf, by the way. And then they'll have a whole reason as to why they're looking for longs or shorts. And they'll take a trade based on that. Cool. So before I do that, I'll get back onto, and then look, you can see that they have all of their reasonings, why they're looking for trades. And what's happening in the world is based on what they're trading. They're exiting, if they're longing, if they're not entering. Everything that's happening in the world, they'll try and figure out what trades to take. But like I said, you don't just use this as, oh, they're looking to buy, let me go out and buy $1. It does not work like that. You use this as a rough gauge, shall we say. So before we do that, let's go off and do the old giveaway. I'm sure we all love giveaways. Let me just add it onto that website. So let me drag this over here. I'm going to add all the names. Let me shuffle just so it's a bit more fair. Shuffle, 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 shuffle. And then, I don't know, let me see. And cool, I think that's all good. Now, image, add background image, add center image. I've never done one of these before, so please bear with me. Looks good, click the wheel, cool. All right, sweet. So let's start. Good luck to everybody. Fingers crossed. Let's see. All right, cool. Numero 1 is... Ooh. Meditation, relaxation, smoothie 646. You have won an Apex account. So please message the staff on Discord. Make sure you message the right one, and then we'll get onto that. But please respond in the chat before we do anything so that we know you're here. If not, we'll respin again, and whoever gets it will get it for obviously Apex. So please respond in the chat so that we know you're here. Obviously, because it'll be a bit unfair if they left and then suddenly, you know, it's just unfair for other people. So please drop it in the chat. Cool. Sweet. There you are. So that's Apex done. Next one is for funded next. Let's do this. Come on. So we'll have to remove you out the equation. Apologies. And yeah, we'll click it again. Let's see. Next one is Swarthy Can't Trades. Cool. Drop that into the YouTube chat, please, so that we know you're here. Ooh, are they here or not? Please drop it in. I'll have to give you... Oh, cool. There you go. Yes, that's correct. Cool. You are here. So you have won a funded next account. Let's remove you out the equation now, and let's see who wins the 3-month TradeZella subscription. We all love free stuff. I know I do. So let's see. Next one is BMW M5 competition. Nice, good car. Are you here? You have won a 3-month Trade Zeller subscription. So if you drop it into the chat, we'll know that you're here. And let's see. But yes, there is a slight delay, by the way. So if I'm pausing and waiting, I'm just trying to wait for it to catch up. But you have won a 3-month subscription. So let's see. Are you here or not? Cool. Sweet. You're here. Amazing. So that is all of the giveaways done. Obviously, please join other live streams so that you can have access to more giveaways. But for now, that is us on the giveaway section. But before I move on to other stuff, let's go back onto this document and talk about a bit more stuff, and then we'll wrap up as that's towards the hour. So let's quickly scroll up to Standard Chartered, which is a good institution, by the way. There is a good trader there called what's his name? Steve Englander, I think that's his name. He's a very good trader at Standard Chartered. But what we have to think about for the Fed is Powell will likely lean towards 25 cut in December, but we expect him to be non-committal on 2026, meaning the markets already anticipate 2 rate cuts, one today, one in December. Cool. If he says something along those lines, that's not going to move markets. Steve Englander, that's the one. He is not going to move markets if he says that. What we want to see is there are other things out there that people aren't anticipating. Meaning, is there a bit more rate cuts in the future to be expected next year, early next year? If that's the case, the dollar will come lower. You'll see a big sell-off in the dollar. Equities, as we spoke about that relationship, equities will rally very aggressively. Yields will come lower. We'll see a lot of bull steepness in the bond market, and that will create a lot of dollar weakness. So what we have to think about for Powell is, does he say anything that the markets don't know already? And we'll know that because you can just look at the chart and that will tell you if something new is said or not. If you see very choppy price action, but it's kind of sideways, basically nothing was said. That's all you have to know. But generally around the FOMC, something is said, and you do tend to see quite a lot of volatility. It generally happens during Powell though. So people will read through the statement that's released at the same time as the interest rate. If nothing new is said, cool. We wait for Powell, and as Powell explains, people are going to think, does it make sense for more rate cuts in the future? If it does, then the dollar will come lower. But that's all we have to do. But before I end it, a few things. We want to say thank you to our sponsors on the right there. As you can see, use code CF for 50% off on your funded next accounts. So please, we appreciate all of our sponsors. Obviously, we wouldn't be able to do this if this wasn't the case. But apart from that, everybody, I believe that is myself. I appreciate you all for being here, and I understand that it's not an easy subject. Okay, I'm not a smart person, meaning I didn't get amazing scores in school, right? So you don't have to be smart. You just have to have the willpower to do it. That's all it is. So apart from that, everybody, I appreciate you all for being here. And if you obviously do have any questions, please at me in the Discord. But apart from that, everybody, have a good rest of your evening. And I will be posting some updates into my channel on the Discord. Apart from that, everybody, appreciate you for being here and take care.